Hello, hello, hello. Welcome to Al Stock Trade. In this video, we're going to go ahead and we're going to complete a intrinsic value calculation on the Clover Health stock. We're going to be incorporating the new changes and the new cuts that they talked about during the earnings call. Before we go ahead and continue, if you can do me a favor, give this video a like. If you can go ahead and, if you haven't done so, subscribe, as it will help the channel grow. We like to focus on thoughtful analysis. If this is the first time you're watching me doing an intrinsic value calculation, I've been analyzing companies for over 10 years. I'm dating myself, unfortunately, here. And we're going to go in and show you exactly how to value a company that's unprofitable, which is a head scratcher, especially when I first learned it. So we're going to go ahead and reread the third quarter earnings results to kind of bring us up to speed, as it's been some time. My apologies. I'm currently dealing with COVID, and I'm just trying to muster up some strength to make this video here. So yeah, just literally treading along here. But if you can, share this video onto the Reddit page, Stock Twits, and we will chat and all the chat groups to hopefully spread the word about Clover. I do believe it's a wonderful company, and definitely the more eyes we have on it, the more thoughtful analysis and comments that we can get from the retail investment community space. So without further ado, I'm going to have the computer go ahead and read this, and I'm just going to have the computer read it to me because it's my throat and everything, and we're going to go from there.
Third quarter insurance MCR of 86.3% and year-to-date insurance MCR of 91.7% demonstrate positive momentum. The company updates 2022 full-year guidance to include improved 2022 insurance MCR range of 93% to 94%. Clover intends to continue to grow insurance business at above market rates in 2023, but will moderate growth to prioritize profitability.
Yeah, so this one's here good. Okay, so Clover intends to continue growth insurance business at above market rates. So what is above market rates? Well, from my understanding, above market rates is around 30. Well, first, what is market rate? Market rate from companies that are at Clover size is approximately anywhere between 25 to 30%. Now they're saying above market rates. Now, who knows? Maybe this could be what they're talking about. We could see growth on the intrinsic value calculation, which you can find in the Mastering Stock Market course link down below here. If you do intrinsic value, we're going to be able to update the growth rate that we believe in here, the short-term growth rate, and that'll help us determine the value of the company. Okay, but they do say that they're going to be moderating growth to prioritize profitability, which is important because that's the market we're in right now. We're no longer in a market that can wait. Okay, we'll continue.
Company outlines strategic reduction in number of ACO REACH participating physicians in 2023, targeting non-insurance MCR below 100%. The company reports strong liquidity.
So let's go ahead and pause this. So I got a lot of requests, especially to make this video, which I understand because this does alter our intrinsic value calculation. Just like I told you in the beginning videos that we had a year ago, that every quarter we're going to get more information from Clover. And every time we get information from Clover, we're going to continue sending out intrinsic value calculation platforms and almost sending out a satellite system to basically get data. We're going 10 years out and discounted a 10-15% discount rate using a 2 to 3% perpetuity model dividing by the number of outstanding shares. We're going to continue basically getting these these stock prices. And some folks are going to be like, wow, well, you keep changing the prices. What the hell is this? Well, that's investing. You can't just set it and quit it. You got to continuously monitor it. And unfortunately, I know this takes a lot of time, and I know but you have to love what you do, right? For me, it's not about the money. It's about the game. Of course, the money is a good aspect of it, but it's about getting it right and playing the game of Wall Street. That's where I get my fun out of this, right? Especially when I see analysts, all up and dewy with Goldman Sachs, and here I am squashing them with my analytical concepts. It feels good, right? But here's the thing. So big one here is that they're going to reduce, right? But the only reason why reducing it is they're reducing the number of ACO REACH participating physicians in 2023. Again, a lot of people are saying, oh, the company is going to basically destroy its revenue growth. It's going to hurt. No. All right. What they're doing is of course, the revenue growth is going to take a hit, but they're targeting a non-insurance MCR below 100%. That's their target right now. Let's just forget this for a sec here, and let's scroll down here. And if you go to the non-insurance MCR, you're seeing 104%, guys. It's up. That's up. That's up from the year before. Year over year, it's up. So that's the priority now. So as an investor, and this is where it's hard to essentially make everyone happy. You're going to have people that are going to want basically growth, right? They're going to I want growth, 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 right? And then they're going to have people that are like, I want profitability. And the thing is, you can't satisfy both metrics. Okay. Right now, we're in the market where if you're a growth stock and you're profitable, you're going to take a hit. Just watch Google, Meta, Apple, Facebook. You see, Apple's down 16, 17%. Meta's down, God knows. And then Amazon's down around 40 to 50%. Any growth company is taking a hit even if they're profitable. Now imagine if you're unprofitable. Now you're talking in the 60s to 80%. Okay. So the goal right now, the market climate that we're in, is that we need to focus on profitability. And once this profitability metric is reached, then we can turn on the hyper growth engine. And I believe this is where this comment comes from here.
The company reports strong liquidity, delaying any requirement for additional capital at least through 2023 and potentially beyond.
So, it reports strong liquidity, and they're going to essentially delay any capital raising until maybe they want to go next to their hyper growth stage. And I believe the next phase of Clover is going to be this guy right here. This is going to be the next. This is going to be the next phase of Clover, and they're going to what's going to happen in 2024, 2025 is you're going to beg. I know that's going to sound like what beg. I don't beg anybody. You're going to beg Clover to raise more money because you're going to see a lot of people sign contracts with them as a SaaS business, right? And you're going to be like, oh my God, get your money, boo boo, get your money. This is going to, because if this turns into a SaaS business, then okay, we're starting to become a technology company. Now, creating a technology company in healthcare is very definitely hard. Okay. And this is where a lot of people are like, I just don't see it. And I have to be quite honest with you guys. I don't see it as well. It's in terms of the SaaS structure yet. But, it's very clear. Vivek talked about this before about like how, once he steps out and then, what's his name? Mr. Andrew Torrey comes in. My apologies. I'm like, what? I'm like, my brain is so fried right now from COVID. It's a mission to like formulate sentences and speak academically right now. It's really hard right now. But Andrew. So when Vivek was talking, he was saying that in about 2 years, people are going to say, "Oh wow, you are a tech company. Oh wow, right?" And this is exactly what's about to happen in the next 2 to 3 years. And I believe this is when they're going to raise the capital requirements needed to generate the next phase of Clover, which is to scale up their Clover Assistant. Now, if you're talking about scaling, they're technically already doing that through insurance. Yes, they are an insurance company, but they're using insurance as a packaged virus to spread their software. Let's continue.
Clover Health the company, a physician enablement company committed to improving health equity for seniors. Today reported financial results for the third quarter of 2022. Management will host a conference call today at 5:00 p.m.
Okay, we know that.
Strong third quarter results, led by significantly improved insurance medical care ratio (MCR), highlight our ability so far this year to drive more and more value via Clover Assistance and Clover Health CEO Vivek Valley. We believe we have proven that our wide network high choice plans powered by Clover Assistant are fundamental differentiators, with our flagship PPO plan recently maintaining a 3.5 stars rating.
Okay, good. And then as these ratings increase, not only does Clover have the opportunity to provide state-of-the-art care to the most historically marginalized of patients, that's the most important. But from the business perspective, it's going to also help with gross margins as well. Let's continue. And profitability.
Andrew Toy, president of Clover Health, added we continue to grow the reach and capabilities of Clover Assistant and believe that our overall growth firmly advances our mission to improve every life. We do that by supporting physicians in catching and treating conditions earlier to increase.
So I'm going to just take a timeout right now. Someone's knocking on the door. I got ice cream. And I ordered it, and my throat's killing me. So I'm going to go pick up the ice cream before it melts. You're like, wait, what? Ice cream? My humblest apologies. Hold on. You guys weren't expecting that, huh? Ice cream? Hold on. Please comment down below in the comment section what you guys want to hear about today. All right. Got the ice cream here. There's going to be, he forgot the other ice cream, so he's going to have to come back. I'm going to have Michelle. I'll let her know. Sorry, guys. Here's here's the ice cream. My apologies. Okay, so let's get back to business here. Sorry, he just says COVID sucks. Okay. Let's go ahead and let's continue here.
Andrew Toy, president of Clover Health, added we continue to grow the reach and capabilities of Clover's system and believe that our overall growth firmly advances our mission to improve every life. We do that by supporting physicians in catching and treating conditions earlier to increase the health and well-being of their patients. I'm pleased that this growth has been accompanied by positive momentum towards profitability.
Here it is. So we do that by supporting physicians and catching and treating conditions earlier. This is big. Diabetes is all preventable. Okay. There's a lot of preventable diseases that, putting someone on a statin can have tremendous life-changing effects. Primary care medicine preventative medicine is key. And in the era of genomics, that coupled with primary care, if you combine those two things, you essentially will have a very strong, impactful company that will be able to really save a lot of people in the healthcare business money, and then will dramatically decrease MCR and potentially create a Clover assistant SaaS company that a lot of people are like, hey, listen, if this is what your intuitive software can do, and it can actually help catch diseases earlier, then you might see Pima County Health Department or whatever county the health department that you're in, they might take this system and purchase it and be able to displace it to these clinics. That could be the potential of this company. The thing is, to get from where they are today till then, it's going to take some time. Okay. Now let's see.
That momentum is reflected in our Q3 results as well as our updated 2022 guidance, which includes an improved 2022 insurance NCR range of 93% to 94%. Mr. Toy continued. In addition, we believe that strong tailwinds exist for our business as we look to 2023 and beyond. We intend to continue to grow our insurance line of business at above market rates, but are also firmly prioritizing profitability for both the insurance and non-insurance lines of business. We will also leverage our learnings under our participation in the global and professional direct contracting model, which will transition to the accountable care organization realizing equity, access, and community health model ACO reach in 2023 to focus on a smaller set of provider groups who we believe are best aligned to our own strategy and capabilities for delivering the best in value-based care. I'm excited about the proven actions that we are taking in our non-insurance business, as I believe they will accelerate us towards speed, profitability.
Very true. So what they're doing now is they're essentially going to be focusing on physicians that are excellent Clover Health Care Assistant users. Okay. I mean, it just makes sense. They have all this data now, and they know after, who knows, maybe a week or two, but I would say after 3 months, probably even before, especially the amazing technologist, Andrew Toy, he has the ability now to look at these data points, and he is able to determine which doctor is going to be right for them. And in the current stock market conditions, what is right for them is maximizing profitability, which is unfortunate, in terms of, from the patient side, but they're going to help those physicians that don't align with that strategy. And if anyone can correct me if I'm wrong, please do on this regards, but this hasn't played out yet. I haven't seen it, and we're going to have to see it when it happens. So, as you know, revenue's up. The insurance MCR 102 to 86. That's great. This is going to start going down to 100%, under 100%. Net loss on average, we want to see 75 million net loss for this year, and then we're going to check it for next year, and we're going to do our analysis. Just one thing though, we are going to be doing our trend line analysis very close here. One moment here. Okay, and then so then here's in this regard. So we're going to do this analysis here, do our intrinsic value calculation, and then we're going to do our trend analysis in the next coming days to weeks, and we're going to continue down here. So insurance members, you can see that They have increased their insurance members or non-insurance beneficiaries, literally more than doubled. Same thing with about double here with total lives under management once you go ahead and combine these together here. So in terms of the financial outlook, this is where we want to go ahead and focus in our attention. Okay, so let's go ahead and read this here.
Third quarter financial results were highlighted by strong insurance NCR performance, outsized revenue growth, and continued moderation of adjusted SG&A growth, said Clover Health CFO Scott Leffler. Third quarter insurance NCR increased significantly year-over-year to 86.3%, and year-to-date insurance NCR improved to 91.7%, driven by favorability and underlying operational trends as our portfolio continues to mature. Non-insurance NCR was 104.2%. The company continued to limit adjusted SG&A growth, and we finished the quarter with cash equivalents, and investments of $783 million. For 2023, we are acutely focused on prioritizing profitability and expect to continue to improve both insurance and non-insurance NCRs from 2022 levels.
Okay, good. Let's continue on here.
Insurance membership is expected to average 86,000 to 87,000, a growth rate of 29%, 30% as compared to the 2021 average. For the non-insurance business, the company expects the average number of aligned beneficiaries to be 165,000, 170,000, compared to an average of 62,125 in 2021. Total revenues are expected to be in the range of $3.2 billion to $3.4 billion. This includes projected insurance revenue of $1.0 billion to $1.1 billion and non-insurance revenue of $2.2 billion to $2.3 billion.
All right, let me just take a pause here and analyze this. All right. Yeah. So as we know, they're raising revenue range guidance here, okay? And their growth rate is going to be 29 and 30%. But again, here, this is the full 2022 year guidance, okay? So not so much 2023, 2024. We're going to get that in Q1 of 2023, but let's continue.
Insurance NCR is expected to be in a range of 93%, 94%. Non-insurance NCR is expected to be improved versus 2021 levels. As in previous guidance, significant developments related to COVID-19 and/or historical utilization trends could potentially impact these expectations. Adjusted SG&A non-GAAP is expected to be between $320 million and $330 million.
Yeah, and sadly, COVID-19 is on the rise again. So and this speaks so clearly as I just got it myself. So it sucks, but it is what it is here. Well, what we're gonna do now we're gonna do what we came here to do. We're gonna do our intrinsic value calculation. Now, what I want to do here is I want to go in on our Discord here, open up Brain Machine, then open up the help section here. Oh, gotta put the help section here. And honestly, let's do share float. Hit up Clover. Let's press this button here. Good. Around 477. We'll up it to we'll just check just secondary here. Yahoo Finance. Curious to see what they're saying here. Statistics. Yeah, they're saying 383. I wouldn't call it that. I would call it 477. So for the share. So what I'm doing is I'm just calculating the shares. We'll do 477 outstanding. Okay. We're going to have them now. Okay, we're doing the value calculation now. Sorry, like it's not as smooth as how I want it to be. Forgive me. I'm on a lot of meds. Sorry, guys. And just really a little just not feeling normal. Growth rate here, 29 to 30%. So we're going to go ahead and we're going to give them we're going to start off conservatively. First we're going to do 35%. We're going to do above average growth, okay? Above market growth. We're going to push this out to 10 years, okay? And then we're going to go ahead and we're going to do their expected revenue here. We'll do the low end, 3.2 billion, because they did say they expected 3.2 to 3.4. So we'll do 3.2 billion. And then we're going to go ahead and do 5% of that, okay? Then we're going to equal it and we're going to multiply it. Oh, hello. We're going to equal it and multiply it by the 5%. Sorry, guys, I'm just not. Okay. Seems to me that might be a little error here. Interesting. Let me go ahead and restart this. I left it open for too long. We're going to go 10 years out. We're going to take the 3.2 billion here, 5%. There it is. 160. It doesn't matter where we put it. We're going to put it here. Now you might ask yourself, why aren't you doing the year before? Well, I'm making an assumption that Clover is going to be sustaining these revenue growths and they're not going to go backwards. If they do, then we're going to add that to our calculation right now. But we're doing 160 free cash flow. And we're going to grow this cash flow. Let's first do 35%. Okay. Now, as soon as we grow this for 35%, we get a recession of $10, a bear case of 22, and a base of 30, and a bull of $45. But not personally, taking a step back, let's go ahead and let's be a little bit more conservative because they said they're going to be growing around 29, 30%. We're going to go ahead and we're going to do it 20%. We're going to go lower. Okay. It's always good to be conservative. We'll make the growth rate lower. And as soon as we do that, now the recession is going to be $4.36, which is still lower. The stock price is lower, right? Than that, right? A bear case of $8.30, a base case of 11, and a bull case of $15.79. Now, we're doing lower than what they're expecting. I'm going to do what I'm going to chuck it to is I'm going to do 25% growth rate. And that's going to give a stock price anywhere between $15 to $22. Now, you might be asking yourself and saying, hey, Al, I mean, you were saying that, this could be, higher. What's going on? It's because we're applying a lower average growth rate. And it seems that they are going to be switching to hyper growth once they figure out their profitability. And I think their hyper growth is going to be coming out in post 2024, 2025. Now it's all about surviving. So, and, creating this brand, right? So this is kind of the analysis here, but what I think is going to happen, and we can, just imagine, they make, let's say $4 billion next year, make $4 billion. And we want to know what would be the free cash flow. It'll be $200 the next year after that. And you can start seeing that, let's say this is 2022. And then in 2023, they're going to be making, let's say, $4 billion. And then 2024, let's say they add another $5 billion to their revenue here, right? And once you do that, we're going to mathematically calculate this. I'm just spitballing here. You start to see that the stock price continuously starts to rise as the company matures. So then eventually when it gets to 2025, we will start seeing a stock price anywhere between $25 to $30, right? But again, I'm conservative. I wanted to be a little bit more, and this is a 25% growth rate, right? If we go ahead and we put their 30, which is what they're averaging here, go down here. Sorry, going up and down here, but this is what it takes to analyze a growth company here. 29 to 30%. If we put the 30%, then we're already at a $25 to $30 level intrinsic value. And then when you start putting the $200, the 200 million cash flow and the $250 million cash flow, you start seeing that we're increasing in value. But what I'm going to do right now is I'm going to be putting the $1,500 they made in 2020, $1.5 billion they made in 2021. And I'm going to be multiplying it here. And I'm going to put their old free cash flow here to average it down. And this is a conservative method right now on where Clover should be trading at right now. It should be anywhere between $5 to $11, which is why they did the what do you call it? The share offering at $5.69 because they were evaluating their growth because they know their growth 30% in the future, right? So this company is completely undervalued. And if you were to just put in the share price right now, and if you go to stock here, and what is it? 128 now? Well, 130 here in the after hours. So if you put 130 here, we're looking at a 300% return in the recession level, an 800% return in the bear level, and at over 1,000% return in the base, and a 1,700% return here. Now, personally, for me, I would say my price target has not changed. I'm just making these models for individuals to see from an educational perspective how this change in growth rate and the slash in one of their growth rates could ultimately affect the stock. But, don't get it twisted. Nothing, in terms of the value of the company, this actually makes the company even more valuable. So I hope that this is, definitely was a good video. But I'm going to go ahead and go down the comment sections here. So, I'm still at an average of $8.40 RAP. Well, you see, and I was just thinking about this, literally. I was just thinking about this exact comment from Smiles. I was actually just thinking about this because I was like, in the shower or something, I know TMI, and you do your best thinking in there, right? And I was just thinking to myself, and I was like, there are people out there that, investors come in flavors. There's investors that just get turned on when the stock price goes lower. And just, if you go to our group, I love our group. If you go to our group, I'm going to put you guys on blast, okay? If you guys go on, put on our group here, you start seeing a lot of comments like here, we have a competition within ourselves, caught 129 over 5,000 shares trying to catch. We make it our mission to catch the bottom of the market. We want Clover to be lower, right? Because the lower it goes, the lower you get to reduce down your average, right? And unfortunately, the issue here is that the issue that we have is that unfortunately, people don't do that. People don't do that. And it's unfortunate that happens. It's unfortunate. And the goal for them in the future is going to be, well, I'm just trying to break even, which is not good, right? Because then, this company has value and it's going to create value. And that's something. So, no, dilution is not factored in this equation. So yes, so dilution is not factored into this. The thing is, how do you calculate dilution? Now we can create a model that factors in a 5 to 10% dilution as embedded within a company. But then that would make the calculation obsolete, in my opinion, because if we do factor in this type of dilution, what's going to end up happening is now our brain machine calculation, if you were to go ahead and go to brain machine, it does factor in dilutions. So if you go to advanced DCF and let's say type in Home Depot, you get a lot more variables and a lot more modelings and models that even the WACC discount rate model we use, which gives you a stock, a value of Home Depot, the stock price, $344, and it does it automatically. If you type in Home Depot here, what was it? My memory is shot, 344. So we're about almost there to its intrinsic value here. What is that? The 15% in a month. So yeah, so that's something that you can do on there. But the issue here with factoring in a dilution within the calculation is that some companies don't do that. What happens if companies buy back shares? You see how that messes up the dilution. Now you can incorporate buybacks within the company, but personally for me, I found this calculation to be incredible because it factors in a bear base, and bull, and also a recession. And within these factorizations are discount rate models that already pre-plan and formulate a pure dilution. Does that make sense? So they already pre-populate a future dilution because we're taking different discount rate models and we're discounting the best case scenario, the middle case scenario, the worst case scenario, and an absolutely crap shit case scenario. You get what I'm trying to say? And you can average those and you can find your own stock price. So I hope that makes sense. I get really nerdy and giddy about this because I do believe we have the best intrinsic value calculation on the market. I really believe that. Our price targets are really on par, and they really are nailed. Well, that's the thing, though. These calculations are without considering SaaS. Well, it depends. If they grow at this rate, then potentially. If they are a SaaS, then we are going to have to do some different calculations. And that's when you get into this calculator here, our linear progression, and our this is when you get into these calculations here. When you do that, and we can do that, we can surely do these different types of calculations where we can project out to these different years here. We definitely will do that. So yes, you are onto something, Danny, when you make that comment. Exactly. Right. But again, I like to focus on what we have in front of our eyes today. I do hope that we do get that SaaS, but definitely can't calculate things that are not yet in stone. That's gambling, and usually don't. Exactly. That's why I'm not doing it yet. It's not. We can. By increasing the price to sales ratio here and the revenue multiple, we can, but we'll do it as more of an academic exercise for sure, just to understand how analysts that work for billionaires, not for retail investors, how they do things. You know what I mean? All right, so let's go ahead and boy, did that ice cream make me happy. I tell you that. They say that's I'm being a very bad role model. Sugar and fats are bad. This is the cause of diabetes. So just be careful. But it's okay to enjoy once in a while. Okay. All right. An apple is better, right? I don't keep apples in the house because we're very scared of apples, right? And someone commented on the Discord. Okay. So so my hospital does not utilize the Clover software. We actually utilize Cerner. And if you were to speak to doctors about Cerner, some will have mixed opinions. That as far as I'm going to go with that. If other people that have different names that are not named want to talk about their experiences with Cerner, be my guest. But definitely, if I must add, the healthcare system needs a centralized a system where multiple hospitals can communicate to one another without having to put the patient in the driver's seat and have them do it. We must take care of them because some cannot do that, especially as we have an aging population where dementia is so prevalent. We need to step it up. This is 2022. This ain't 1940s, 50s. We have some good technology that we can utilize in healthcare. So here, what could retail do when buying CLOV on any platform that have a payment for overflow? Well, yeah, and that's exactly what might be happening right now. But not to worry, Dave, here. Not to worry, because, if you think about it in the long run here, stocks always ascend to its intrinsic value. But obviously, you have to find the right stocks. You can't find garbage stocks. Like just today, we posted a video on YouTube talking about our top semiconductor stocks. Some of our stocks literally went up 45%. 45%. And that's what happens when you pick good stocks that are going in the right direction. Okay. So if you pick bad stocks, then then of course, dark, short sellers are going to manipulate them because they are crappy stocks. But I think what Clover is, it got tagged down and tied down as a SPAC. And I believe that there is potential in this company. You know, it's either, it could be at this point, it got hit so hard that it's a 10x in my books from these current share prices. I mean, $15 is just such a good price right now. And if you don't think 1,000% return is good, oh man, I don't know how to help you, right? You know, find me something that's not a Ponzi scheme, then I'll be very excited. All right, I'm just reading the comments here. Yeah, and that's unfortunate, right? And that is unfortunate. What we can do, and you know, and this is like the question is like, you know, how do I average down and not run out of money? You know, I always like to follow smart money and hedge fund exposures and equity hedging index. I mean, honestly, if you would have just, I was asked myself, well, honestly, just buy at these peaks, and I would do great. You know, you buy a bunch here, you hold, you wait for the next one, buy a bunch here, you hold. I mean, this really is a great way to look at the dips. Every time this thing spikes, it's just a perfect time to buy, and we're starting to get a great time to buy in our equity hedging index. Likewise, if you look at our hedge fund exposure, which we'll talk about more, if you look at it, this is a part of our private group here. We talk about these things. If you look at our hedge fund exposure, I mean, every time we get down here on the, if you go down all the way here, track it down on the low end, it's such a great time to buy. And if you look at the how sensitive this is, you can tell I don't like to buy things when the hedge fund exposure rates are high, because indexes will most likely outperform. Now it seems that stocks, individuals, are going to be outperforming, and definitely is something that I like to look at myself. So there's definitely a lot to look at, a lot to analyze, and I'm going to be making another video that's a lot shorter to help people that unfortunately don't have time to go on in-depth analysis. But we're going to do a quick boom, 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 and then we're going to go ahead and post that video in the future here. Let's see here. All right. So that's all I have for you guys. I hope that you enjoyed this video. Definitely. So we do have a Black Friday coupon code sale down below. Black Friday, it is the biggest sale that we've ever had. It's $500 off our mastering, and we will be increasing prices after the new year. So they definitely take advantage. The Black Friday sale is going to be ending at the end of the month. And that's all I have for you guys. And comment down below what stocks you guys want to look at, especially during this market time. And we're going to get back to our schedule and our analysis on the bi-monthly meetings. We just had one, but we're going to get on a better schedule once I heal up and things are a lot more, a little clearer in my mind. All right, guys. See ya.